Part 1A. Let's read the requirement again. Prepare all the journal entries required to account for the debentures issued by Better Build Limited on 1 October 2018 in the financial statements for the year ended 30 September 2019. Journal entries relating to your current tax are not required. Assume a tax rate of 28% and an opening balance of 0 on deferred tax. Therefore, we need to remember our deferred tax. Okay. Ignore closing journals and round all amounts to your nearest rand and rates to 2 decimal. Okay, presentation marks 1 and total of 20 marks. On a new page, guys, and I always do this because this helps me. This is part of my exam technique. Remember, this is financial instruments. On a new page, I will indicate that this is my part 1A for my marker. I include my timeline, and I know that this is a convertible debenture. Therefore, I have included the steps. But guys, you don't write this out. This you need to know. You need to know that you need to calculate your future value of your instrument at initial recognition. You need to calculate your present value of the liability component. And then you need to determine the equity component, which is the difference between step 1 and 2. And remember, if there's transaction costs, that you need to allocate this proportionately to your liability and your equity. Now, let's refer back to the reading section and ensure that we understand the information provided. Right, when we look at the information provided, I'm pretty sure all of the different rates confused you. Now, guys, you can expect anything in the exam, but you need to tell yourself to remain calm and think about this. And you know what? If you don't know this section, you won't fail the question. There is other marks available. You just need to read properly. Now, we're going to work through this from the top. The first paragraph under 2.2, guys, a little bit of background info only. They indicate to us in the second paragraph, in order to finance the development, they issued the following convertible debentures. Now, think about this. If they issue the convertible debentures, they will have to debit bank because they will receive the money, and then credit the financial liability and the equity. You with me? We have determined that we need to calculate the present value of our financial liability, and our balancing figure between step 1 and step 2 will be our equity. They indicate to us the date issued is 1 October. Face and fair value will be the 300,000 Rand, and there's 500 debentures. Therefore, we now know that this will be our future value. If someone purchases a debenture, let's say, for example, we purchase this debenture, we will purchase the debenture to be able to receive that 300,000 times 500 at the end of the period. Okay? Therefore, that's our future value. We have a 3% transaction cost of the face value. You need to read the face value, 3%. Then, interest rate, annual Johannesburg Interbank Acceptance Rate, which is our JIBAR, plus 2.25%, which is paid quarterly. Okay, now let's just look at the first section. This is JIBAR plus the 2.25%. Now, you know that JIBAR will be the rate that our Reserve Bank provides loans to ABSA, FNB, Standard Bank, and so forth. But now, this, guys, important, plus this 2.25%, this is linked to this specific product and this client. Therefore, when you enter into a debenture, okay, that rate, this rate here, relates to your client and the possible risk of repayment. Think about this. When you purchase your vehicle for the very, very first time in your life, let's just use an example. You purchase your vehicle for the very, very first time in your life. You have never, ever, ever had any liabilities. When you enter into an agreement with a bank, your rate is pretty high because this is your first vehicle. There's no credit history. Okay, so this is what I want you to understand from this question. That 2.25% relates to this specific client. Okay, then they indicate to us here, conversion. Each debenture is convertible at the option of the holder into one ordinary share. Conversion date is 30 September 20.20. Therefore, our period, we will be able to determine, this will be from 1 October until 30 September 20.22. But important, the payments is quarterly. Okay. Notes. If the holders choose not to convert their debentures into ordinary shares, each debenture will be redeemed in cash at face value on 30 September 20.22. Okay, so let's just quickly stop right there. Now, we know that we will have to determine the future value of our instrument at initial recognition. Remember, at initial recognition will be 1 October 20.18. Therefore, our step number 1 will be the future value. We know that this is the 300,000 times 500 debentures, and this is 150 million. You with me on this? Okay. Step number 2, we need to determine the present value. We know that the future value will be the 150 million. Okay. We know our period will be from 20.18 until 20.22. Therefore, this will be a total of 4 years. 18, 19, 20, 21, 22, 4 years. But the payments will be quarterly. Therefore, times 4. And this will be 16. Okay. Now, the specific actual, now guys, important, this is the actual payment. Remember, this is the actual cash flow, which is linked to this transaction, this specific transaction. You with me? This will be the 150 million times the JIBAR plus the 2.25%. Remember, they've indicated to us here in the scenario that the interest rate will be the JIBAR plus the 2.25%. Therefore, we need to determine what is the JIBAR on 1 October 20.18. This is at initial recognition. Now, when you look at the second paragraph below your table, they indicate to us, on date of issue, yes, 1 October 20.18, BB's management expected the annual JIBAR to be 7.16. Therefore, initially 7.16%. This is what we will use on initial recognition. And this will then be the 150 million times the 7.16%, brackets guys, plus the 2.25%. Yes, and the payments will be quarterly. Therefore, divide this by 4. And this will be an amount of 3528750. Right. Now, the interest rate, remember guys, the payment is linked to this specific debenture, this specific client, this specific debenture, this specific period, this debenture. Now, when we calculate the present value, this I, guys, relates to a normal scenario. Okay. Therefore, if I indicate to you a normal scenario, when we refer to the given scenario, they indicate to us the paragraph below the table, guys. If BB, this paragraph below, issued debentures without a conversion option. Remember, we normally use this without a conversion option. The fair rate applicable to these debentures on 1 October would have been annual JIBAR, yes, plus the 2.75%. Okay. Therefore, when you look at this, this will be what the market will charge if this is without the conversion options. Okay, now guys, I'm lying to you. This is not what the market will charge. This is what BB will charge without the conversion option. Okay, therefore, we need to include our rate, which will be the 7.16, our dry bar, plus the 2.75. Remember, we use the one without conversion. And that will be our rate that we use to determine the present value, as if there is no conversion option. Why? Think about this. The liability normally relates to the cash if they are not going to choose the shares. Therefore, without conversion, conversion means converting this into shares. Therefore, we need the value as if they are not going to convert this. Guys, you with me? Okay. And this will be the 7.16 plus the 2.75, and this will be the 9.91%. Now, important, divide this by 4 because quarterly payments, and this will be 2.48%. And our present value will be 147,499. Sorry guys, I just want to move this. This will be 147,499,340. Okay, so guys, I have checked my calculations with Excel. If you do this with your calculator, there will be a slight difference. Please still allocate your marks when you mark this. Okay, now when you look at this, we have determined our step 1 and our step 2. Our step 3 will now be our equity portion. Therefore, our equity portion will be the difference, and this will be the 25,00660. You with me? We cannot include our journal entry at initial recognition, but we need to determine what type of liability will this be before we do this. Now, when we refer to the given scenario again, you will remember that they have indicated to us, the paragraph on the left side of your screen. Because BB's assets are primarily investment properties measured at fair value, BB designates interest-bearing financial liabilities at fair value in terms of IFRS 9 for reporting purposes, wherever they are not managed measured at fair value through profit or loss. This is consistent with the documented risk management strategy. In the opinion of BB's management, this also provides the most relevant information for the users of the financial statements. Therefore, they indicate here to us, guys, important. This will be financial liability at fair value, right? Now, when you refer back to your financial instruments principles, you will remember financial liabilities can either be 1 at amortized costs or 2 at fair value through profit or loss. But then they need to designate this at fair value through profit or loss. Now guys, majority of our examples, we had this one. But now we have this one. Now don't freak out. Basic principles, get back to basics. When you look at your timeline, you need to identify that you will have to determine the fair value at year end. Okay? Now what I want you to do is please open your financial instruments revision page for me.